No.
Thank you.
You said Anita can't be here, Jennifer?
Correct.
Now, where is she?
I don't know. She just told me she would, when I sent the agenda, she said she would not be attending.
Okay.
Mr. Young, just a reminder that the trustees that are participating remotely should state their location. The VEBA board hasn't met in a while, so I just want to remind everybody to do that.
Okay, we are streaming live to YouTube.
Okay, who's our clerk?
Hi, it's Deanna. I'm here.
All right, we'll go ahead and call the Genesee County Retirees Healthcare Plan and Trust to order. Madam Clerk, please take roll.
Alguire,
Present, Clio, Michigan.
Brandon,
Present, Flint, Michigan.
Galida, Gorman,
Present, Flint, Michigan.
Pepin, Potberry, Simpson,
Present, Genesee County, Michigan.
Young.
Present, Genesee County, Michigan.
Okay.
All right, do we have any public address to the board? Have you received any notifications, Jennifer?
We have not.
So no emails, no phone calls, no voicemails, correct?
Correct.
And there's nobody at your office wanting to address the board, correct?
Nope.
All right, under communication items, we have communication that I had been sworn in by Leslie Raleigh on January 29th, 2021 to the VEBA. Next item we have is approval of minutes. We have the meeting minutes of November 9th, 2020. What's your pleasure?
Brandon will move to approve.
Support.
Been moved by Brandon, supported by Gorman. Is there any discussion? Seeing no discussion, all those in favor signify by saying aye.
Aye.
Opposed? Anyone opposed? Motion carried. All right, we have no old business. Moving on to new business and co-consulting. Chris, you got the floor again.
Good afternoon, everyone. And
Good afternoon.
you want me to share?
Yes, go ahead.
All right. Hopefully it's okay. I'm going to take things out of order. I see that the performance report is C, and it probably makes sense to kind of cover that one first. So I am going to cover the 12/31/2020 performance report. Hopefully everyone can see that all right. This would start, I want to say like page 37 or so in the agenda packet, or 36. And for those of you that sat through the retirement meeting, you're going to get to hear some of the same stories again. So the first being that in the first performance report of each year, so the fourth quarter's report, we generally have included a letter from the president of our company, Mike Welker, and this is no different. We have the letter, and really we want to say thank you to all our clients. We recognize that it was a pretty challenging year, 2020, for everyone, and ANCO was not immune to that. I will share with you, I feel we were maybe a little better prepared than some for it, in that we actually had several remote offices already set up. So the Michigan office is one of those remote offices, with our headquartered down in Orlando. And so when the work from home orders came across the board, many of us were kind of already up and running, and there wasn't really a big shift in the way we do business. And hopefully you didn't really see any change in the services from us over the course of the last 9+ months at this point, as we've been able to deliver our reports to you as we have in the past. The biggest difference just being we're no longer sitting in the council chambers, we're all sitting in front of a computer screen somewhere in the Flint metro area or somewhere around there. The other part, we did continue to add to our organization. So the good news is we continue to grow. A lot of that's just going to be based on the appreciation in the market. We crossed over about $100 billion in assets under advisement. We've added a couple new people to our research team. We've also added to some of the support team across our different areas. So in technology and compliance and human resources, I think they all picked up about one person. And then we did name two new partners, Jacob Peacock and Dan Osika. Both were named partners this year in January. So the last thing, and for many of you, you probably weren't around when we went through this process, but we actually rebranded our company a couple years ago. And before that, we were actually called the Bogdan Group. And we went through the process of coming up with a new name. And so we came up with this ANCO name. And a lot of people kind of think it's a little bit goofy, but there was actually a lot of thought that went behind it. And the idea is to kind of reinforce every day that our clients come first. So what we want you to think is Genesee County VEBA and Company, or ANCO. We're that part of the relationship. And we want you to think of us as kind of that first person or the first group that you might call if there's ever an issue. And it kind of as reinforces to all of the employees that our clients come first. So we have a quick recap of the markets. And, it was an incredible year. So if you look at the fourth quarter, we really finished off strong. We saw the S&P gain about 12%, and small caps at Russell 2000 actually did a lot better. You can see it was up about 30+% for the quarter. The international markets kind of came in somewhere in between there. You'll note that kind of the total international market was up about 17, with the emerging markets really kind of taking the lead. They were up almost 20 for the quarter. And then in fixed income, we actually had positive results in the fourth quarter. Interest rates were relatively stable during the quarter, but we did see a continued rally on the corporate bond side as spreads continued to narrow as we went towards the end of the year. And then if we look at the full year results, as I said, these are just incredible. When we think back of what happened last year with a global pandemic, basically a complete economic shutdown of the world. So, starting kind of in Asia, moving into Europe, and then over here into North and South America. And then kind of this gradual reopening with starts and stops, particularly if you're looking overseas right now in Europe, where they've kind of reset and are starting to go through the process again. And yet, if you look at the equity markets, the S&P was up 18%. That Russell 2000, our small caps, were up 20. And, the international market's not quite as strong, up about 11, with the developed markets kind of the weakest link there, up 7.8%. That's that MSCI EFA index, or EAFE. As I said, just an incredible run in equities, basically the second half of last year, and actually starting a little bit even in that second quarter. And then in fixed income, we saw great returns as well. 7.5% from core fixed income. Going into the year, we had yields in like the 3-ish range. We did see basically a collapse in the yield curve as the government put us back at 0% interest rates at the front end of the curve, trying to keep the equity markets and the fixed income markets, the liquidity there, and then kind of spurring economic and fiscal initiatives to help support individuals in the markets. And so a 7.5% return there. I will caution everyone, your current fixed income portfolio at this point probably yields just over 1%. So if we do see interest rates kind of continue climbing, that's not good for fixed income markets. And there's the potential that we're going to see negative returns in fixed income over the next couple of years. Any questions kind of market related? All right. quick financial recap for the quarter. We started just over $7 million in the fund. And we actually had contributions from the county of about $9 million. We had distributions of about $4.5 million. And you can see a small return on investment. We ended the quarter just under $12 million. So we've continued to kind of move in the right direction here in recent quarters as the county has started contributing, I would say, significant amounts of dollars. And then we have performance. I will point out, so, the performance on this is going to look a lot different than most others. We have a significant allocation to cash, and that's because we have a lot of money coming in, but we also have a lot of money going out. And, this is a fund that we've kind of ran a full cycle with, in that at one point we were at $40 million. And then I think at the low point we were under $4 million. And now we're back, as I said, around, just over 10. So liquidity has been a big focus, and maintaining cash to pay upcoming benefits has been kind of the primary objective here in the last couple of years. And so when we look, we've actually a pretty simple portfolio, a little bit of intermediate fixed income and some very conservative equities. And so that's where the total fund came in, just under 1%. And you can see pretty close to our policy index. The policy index was about 1.6. The biggest difference there is we had more cash this quarter due to that large contribution from the county than kind of our policy index. And as I said, that's a moving target that, we actually see somewhere in the neighborhood of $1 million or plus going out each month. And so we do have to maintain liquidity for those. For the full year, you can see we're up 82 basis points, a little bit behind our policy index. I will point out, with the markets kind of taking off like they did last year, that typical 60-40 pension fund that we're comparing ourselves to here did much better. Much higher allocations in equity than we did, much smaller allocations in cash than this strategy. And so it's not really an apple to apple comparison. On the low vol side, you can see the low vol actually was up 5.3%, which I would say in an absolute term is a pretty nice return. But after looking at what the equity markets did in that fourth quarter, you'll note that it was well behind the S&P 500 and the Russell 2000. It partially due to the conservative nature. We typically don't expect this strategy to kind of keep pace in that type of market. We would hope for it to kind of protect on the downside. And then you can see over the last year, it's down 1%. So really struggled. It was down, I think about 30% in that first quarter, just like the S&P 500 was. And then as we've had the recovery over the last 3 quarters, it just has not kept pace. And that's where we see the underperformance to kind of its peers and why it's in the 97th percentile and underperforming the S&P 500. I will point out, if you look out since the inception, it actually has done nicely on an absolute basis. You can see it's up about 9.4%, and not too far behind kind of the average manager in that large cap core space. That's just under 13. Telemus is our fixed income manager. And I will, performance this quarter was basically on top of the benchmark. And you can see longer term, it has basically struggled to kind of keep up with the benchmark. Over the last year, it did about 4.5%. The benchmark was up over 6%. And then longer term, you can see it closes the gap a little bit, but its relative performance has struggled. And we've talked about this manager for some time. As the fund was dwindling, the thought was just to kind of ride it out, and at some point it would end up being down to 0. At this point, it seems like we're going the opposite direction. And so we have included some options as potential replacements for this Telemus strategy. And then lastly, we have the Patriot Fund. That's a real estate investment. This we've actually put in our request for a full redemption. We're still waiting on that. We get little pieces of it every quarter. You can see for the last quarter, it was up about 50 basis points, a little bit behind kind of the core fixed income strategy or a benchmark. And if you look out over the last 3 years, it's basically performed right in line. And if we go a little bit further at the 5-year mark, you can see it's actually a little bit ahead. It's performed well, but as I said, with the thought of the fund kind of going down in value, we had to put in a redemption notice to kind of keep us within our investment guidelines. And with that, I'm going to pause and see if there's any questions.
Looks good, Chris.
So, as I said, I'm going to just show a quick update for the month of January. And January was an interesting month. You know, the market actually went down, if you're looking at the S&P, about 1%. And, you know, there was, I would say, some concerns about the stimulus package. I think that was probably what weighed on the markets more than anything, as, and I guess the second part being the upheaval we saw in Washington, kind of, you know, was there going to be this smooth transfer of power? As it says, that kind of went to a side. You know, the markets have recovered a little bit. We actually have hit highs here in February again, but it was off about 1%. The interesting one's that Russell 2000. And as I mentioned, some of you are going to hear kind of the story again. The Russell 2000 really was kind of the GameStop story. So for those of you that kind of follow stocks at all, towards the end of January, you started hearing these stories about the stock GMS, it's called, or GSM, yeah, GameStop, and how the stock price of it just soared. And really it was based on kind of a message board, Reddit, where people kind of gathered together and started saying, you know, we should buy this stock. That was part of the story. And I would tell you, GameStop was the perfect storm or the perfect stock for this to play out, in that it was a relatively small stock, so there weren't a ton of shares outstanding. But the other part of the story was that there were a lot of hedge funds that were short the stock. And so when I say a lot, for every stock, every share that was outstanding, there was about 3 shares shorting it. And so when I say shorting, it just means that that's a device in our equity markets where you can sell the stock today, even though you don't own it, with the thought that you'll buy it at some point in the future at a lower price. So traditionally, we think of, you buy a stock today with the hope that you sell it in the future at a higher price. Shorting is the exact opposite. We sell it today at the higher price and we buy it at some point in the future. And the reason I mentioned GameStop was kind of like the perfect candidate. It's a stock that people knew, because most of these traders tended to be on the younger side. And so they actually probably grew up going to GameStops, and then they could recognize the fact that they probably haven't been in one in the last couple of years because the business model itself is kind of obsolete. It was based on mainly kids trading their video games, and GameStop collected the difference between what they bought and sold them for. As kids have no longer bought disc and just downloaded games directly onto their devices, well, there's no need to go into a GameStop anymore. So they were familiar with the business model and the fact that it was, you know, a struggling company. They also were sophisticated enough to figure out that there were a lot of hedge funds that were short the stock. And so when they got on these message boards and kind of suggested to each other that they should buy the stock, well, they started driving the price of the stock up. And as the stock goes up, those people who are short all of a sudden have to come up with more money. So if you sold it short, meaning you sold it today at $20 a share, and then the price of that stock goes up to 40, your broker is going to call you and say, oh, by the way, you have to put in twice as much capital that you had for that stock. And then as the price went from 40 to 80, they're going to make that same call again, but now it's doubled again. And theoretically, the amount that you're at risk is infinite, because the stock could technically go up forever. But what ended up happening is, as those shorts, the people who were short the stock wanted to kind of get out, well, the way they get out is by buying the stock. And so they ended up then driving up the price even higher as they were buying the stock as they were trying to cover their shorts. And so, as I mentioned, there were about 3 of these guys for every share that was outstanding. That's where we saw the second leg of that price appreciation, and the stock went from 20 up to about 400 and some at its peak. That stock alone accounted for almost 1% of the performance of that Russell 2000. And I actually, in between our meetings, I took a look and found the email I had about the performance of the Russell 2000. And it was basically the stocks that were shorted over 10% accounted for all of the performance, that 5+% return for that Russell 2000. So you took those out and the index basically was flat. So just an interesting little story of what happened in the market. I don't think this is the last time we're going to hear something like this happen. That said, I'm not sure we're going to see it kind of to the degree that we saw the GameStop story. As I said, that was kind of a perfect candidate for this to happen with. Any questions kind of market related in January? All right. So I do have some updated market values. Let me make this a little bit bigger. These are updated through January 29th. And you'll note that it's still just under $12 million. Not a big change anywhere across the board from the last month. We'll point out we have approximately $1.5 million in that Telemus strategy. Technically, we should probably be adding to it. We want to make sure though that we're only adding to the extent that the money won't be needed for benefits in say the next 3 to 6 months. So we always want to be aware of kind of what our liquidity needs are before we start putting money into either the stock or the bond market. As I mentioned, Telemus has, I would say, done an okay job. We actually think there are probably better strategies out there for you, and that's why we included this intermediate fixed income manager search for you. We've included 3 candidates in the search. I will point out one of the thoughts that we have for you is that given the size of this portfolio, which, as I said, roughly at this point, $1.5 million, it may go up, may go down. It's currently invested in a separate account, which means that Telemus is actually holding individual bonds on your behalf. We think a mutual fund probably makes more sense for you. It will provide better liquidity and better diversification. So that instead of them having to sell individual bonds whenever we need to raise money, or if we are able to invest more in the strategy, they would go out and have to buy a whole bunch of bonds. With a mutual fund, it would be a single purchase, and there would actually be more liquidity associated with it. So we think that's probably a better approach. We have 3 candidates, as I mentioned: Baird, Metropolitan, or Met West as we refer to them, or Western Asset Management. And you can see the fees on these with their minimums. We should be all set from a minimum for Baird and Western. The one where we're going to have to kind of ask for some flexibility is with that Metropolitan West one. You can see if we can get into the institutional share class, it's 49 basis points. If not, it's 71 basis points. And so we'll have to see if Comerica would be able to help us out on that one, if that's the one that's selected. And currently we're paying Telemus 30 basis points as a reference. Just a little firm background. Baird based out in Milwaukee, and then both Met West and Western are located out on the West Coast in the LA area. All of these are ran by teams. So when I say team, there isn't a single portfolio manager responsible for putting in the bonds in the portfolio. There's a group of people. In the case of Baird, it's 8. In the case of Met West, there's 4 portfolio managers who are then going to be supported by a team of analysts. And you can see the team of analysts is down here, number of investment analysts. So very large groups that are analyzing all of the different types of securities in that US fixed income market. A little bit about the strategies. All of them have been around for quite some time. You can see, I think the baby in the group is actually Baird, and it's about 21 years old at this point. All of them are open. We're using that intermediate government credit benchmark. So one of the reasons that's what we're currently using, but to continue to use that, because with interest rates as low as they are and the thought that interest rates might go up, having the intermediate benchmark means you have a little less interest rate risk. And it just means that in a rising rate environment, it tends to outperform kind of the core market. You'll note under the style, it's core for all of them, relative value for all of them. And when they say relative value, meaning they're just trying to find where they think the best type of securities are. So it might be in financials in the corporate sector, or it might be in utilities. There might be certain mortgages that are more attractive than others based on unique features. So maybe the market's preferring 30 years over 15 years or vice versa. They're just looking to find where the best values are. And then under the duration, you'll note Baird says neutral. They're going to their duration is going to be basically on top of the benchmark. So they're going to take the exact same amount of interest rate risk as the benchmark. In the case of MetWest and Western, they're actually going to have a relative part with that. So they're going to take a look at what the benchmark's duration is and then move a little bit around it. So if they think interest rates are going up, they would go shorter than the benchmark, meaning take less interest rate risk. If they think interest rates are going down, they're going to go the opposite direction and actually go a little bit longer. And you can see in the case of MetWest, it's 1 year. So if the benchmark is about 4.5 years, then they could go 3.5 to 5.5. And then Western is 20%. So kind of a similar type of, they would be able to have a similar type of range associated with the duration as the Metropolitan West. Typical number of holdings. You'll note these are all very, very diversified portfolios in the hundreds of securities. That's what I mentioned about the mutual fund being a little bit more attractive. It is going to provide us a little bit more diversification than we would have. And they're typically all underweight, like the US Treasury part of the market, just because that's the lowest yielding part. So if you look at sectors typically underweight, you'll see US Treasuries and agencies. I will note, if you look down here towards at the bottom, the maximum foreign exposure, it's 0 for Baird, 10 for Metropolitan West, and 25 for Western. And then the use of derivatives, you can see no for Baird, Metropolitan West is yes, as is Western. And, just as you look at some of that, as we look down this list, what you may have noted is that the Baird is probably the most conservative of the group. Their interest rate is right on top of the benchmark. They're not using derivatives. There's no foreign associated with the portfolio. This is what I would really say is kind of a meat and potatoes type of fixed income strategy. They're typically going to be overweight some corporate bonds versus the benchmark, and they're going to move around within the corporate market trying to find the best securities, and that's all they're going to do. The Metropolitan and the Western portfolios, they're going to try doing a little bit more. So they're going to move around on the interest rate side. They're going to use some securities that probably fall outside of the benchmark. They're going to use some derivatives, all of ways of trying to capture a little bit more return than what would be provided with just securities, fixed income securities. That makes sense to everyone? Yeah. See, I'm going to try jumping ahead maybe a little bit. So just on this one, the effective maturity of the portfolio. Remember what I mentioned about their duration being neutral for Baird? They're the blue line. They're going to be the blue everything in the report. So the colors stay the same. Notice on this effective maturity, it's a pretty consistent line versus like the Western, which is the green, where they're jumping around quite a bit. That is, I would say, kind of what I was mentioning about being a little bit more conservative in nature. They're going to be a little bit steadier. They're not going to see some of the swings that you're going to see with the other strategies. The other one was with the duration. That's really the measure of the interest rate risk. Once again, you're going to note that Barrett is the most kind of consistent or the straightest of the lines. The other two, Metropolitan West and Western, are going to be kind of jumping around a little bit. And then we have the performance starting on this one. So what we're looking for is, outperformance to the black box. So, I generally will probably start at like the 5-year and note that over the last 5 years, the benchmark has done 3.6. Metropolitan West is the one that's, has provided the least amount of excess performance. They're 3.8. Barrett has done a little bit better than them. You can see about 4.1. And then Western has done a little bit better than them at 4.6. And when we kind of move out towards the longer terms, generally that excess increases for all of the managers. I think Western's pretty consistent at being kind of the top of the group across these periods of time. And then if you look, this is the calendar year performance. I always think this is an interesting one. And what you'll note is, at least this is one of the notes I have, in the down years, so like 2018, 2013, one of the managers that struggled the most in those periods was the Western strategy. They typically came back with the biggest rebound the next year. So if you look at 2013 and then you look at 2014, it's almost like a reverse order, right? The manager that did the best in 13 is the worst in 14 and vice versa. You kind of see a similar dynamic in 18 as well. And then you look at 19. Once again, kind of that reversal occurs where the managers kind of come back in line. Any questions? This is one of my favorite charts, particularly the top. So what this is showing you is how often the managers outperform over a 3-year period. So to the extent the manager's line is above the dash line in the top chart, that means they have outperformed over the prior 3 years. So this is a rolling 3-year chart, and it shows you can see 5 years worth of 3-year returns. And when they fall below that line, that's when I would come in with a performance report where the manager has underperformed their benchmark for that period. And what you'll note here is, Baird and Western have pretty consistently outperformed. The one exception was, you can see that first quarter 2020, when the market cratered there in March of 2020, and corporate bonds sold off strong. All of these strategies really struggled. All of them underperformed, and then you can see they basically bounced back up with the recovery that we had in the second and third quarter. And then standard deviations, so measure of risk, and you can see they're all pretty consistent here. The one note, Metropolitan West probably has taken a little bit less risk than the other managers. And then this is the other way people have historically looked at these strategies. This is that risk return plot. So to the extent you're above the black square, it just means you outperformed. And to the extent that you're to the right of the black square, just means you took more risk. So ideally, like you can see right here, the Met West is in the ideal spot. It's a little bit above and a little bit to the left. Upper left-hand quarter is typically where we want to see these managers. I will point out, the scale is pretty small. The standard deviation 2.5. These managers are pretty close across the board. So we're kind of splitting hairs with pretty fine scale on the bottom there. I think we have some longer term history with these. And so, I've jumped ahead to the 10-year exhibits, and you'll note like standard deviation, the Metropolitan West is at the very bottom. All of them are in the bottom quartile. And that's the same thing we saw in that earlier chart. The Sharpe ratio is a measure of return per unit of risk, and we're using the standard deviation as our measure of that risk. So here, the higher up you are just means the more return you got per unit of risk. So that low standard deviation that we see for Western is why you see their Sharpe ratio is so high. And then we do this the same way for the information ratio. So the information ratio is very similar to the Sharpe ratio. The difference here is that we're not using the standard deviation, we're using the tracking error. And the tracking error just measures how much different your returns are than your benchmarks. So in the case of Baird, where they actually are very close with their strategy to the benchmark, they have the lowest tracking error, meaning they behave more like the benchmark than anyone of the other two. That's why you see they have the highest information ratio. So depending on how you're looking at risk can kind of give you different answers on these. So, and then in the back of the report, we have the write-ups on the individual managers. I think I'm going to pause there, see if there's any questions. All right. We have a couple options available. One is we could interview candidates if you would like. One is we can just continue using Telemus if you would like. Or the third option is that you can ask for a recommendation from me.
I think, from my standpoint, I'd like to see what kind of recommendations you come back to us with, Chris.
So I will tell you, my first choice for you is Baird. This is it's the most conservative of the group. And with this portfolio, as I said, just coming out of where we were, I think the more conservative the strategy makes the most sense for you. It also is the lowest fees of the group. So I like that as well. And as I said, I just think, it's a strategy that I don't think we have to worry about, where the other two can kind of sometimes get in a little bit of trouble with the use of derivatives or with the mismatch with interest rates. As I said, we take all of that off the table by using the Baird strategy.
Yeah, do we have one of the pages here, and I'm sorry, I'm getting a little mixed up between all of these forms. Do we have a page that's showing basically the ROR net fees?
Everything in the report is net. So if we were looking, it's the page number 12, and if we're in the agenda packet, I could pull it down real quick.
Would that be in 1B or 1C?
1B. And I want to say it's slide 19. Oh, C1B. And it's slide 19 and page number 12. So if you look at the bottom right, underneath that little ampersand, there'll be a 12. And so these are all net of fee returns. I will point out the fees that you look for telemus in our performance report are gross of returns. So you would have to take 30 basis points off each of the annual returns to kind of get an apple to apple comparison.
Yeah, it kind of looked like just, you know, what I was seeing looked like Western was doing a lot better overall to us. But again, this is the kind of the first deeper dive that I've been able to do with this since this is the first meeting I've been at VEBA. Have we done any investment committee meetings with this group in a while?
We have not.
So that's something that I think we might want to start looking at a little bit, you know, as we go forward and that. And I think I'll kind of leave that open and reach back to you, Chris, and talk to you a little bit, talk with a couple of commissioners and see what they say about it. And, you know, and then we can just follow up from that if nobody has any objections.
That's fair.
Does that sound good, John, Alan, Bob?
Yeah, that's fine.
Sounds good to me.
That works for me.
Sounds good then. So we'll reach back out to you on that.
Okay, perfect. I think the only thing we really would need at this point would be a motion to accept the consultants' reports.
All right, I'd entertain that motion.
So moved.
Moved by Potberry,
I'll support.
supported by Bob Gorman. All right, is there any discussion? Seeing none, all those in favor signify by saying aye.
Aye.
Opposed? Motion carried. Thank you, Chris. Right, next item we have is summary of billing and billings expenses through January 31st, 2021. What's your pleasure?
Move to approve.
Then move to approve. Is there any support?
I'll support.
It's been supported by Gorman. All right, any discussion, any questions? Seeing none, all those in favor signify by saying aye.
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 Opposed? Motion carried. Next item we have is approval of Comerica Bank Authorization signers list. And we do have an update from Jennifer on that. I think Jennifer suggested a change.
Yeah, there was a change suggested to have 2 people sign instead of 1. So if the board would like that, then I will go ahead and amend it to 2 signatures for any transaction.
And I believe that was Crystal's recommendation at the GSERS meeting was a similar thing. So at this point in time, I would entertain a motion to accept the authorized signers list, including 2 signers. You're still muted, John.
So moved.
Is there support? It's been moved by Potberry, supported by Simpson. Any discussion? Seeing none, all those in favor signify by saying aye.
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 Opposed? Motion carried. All right. C4, we have to adopt the signatory resolution.
Make a move that we adopt the resolution.
Okay, it's been moved by Brandon. Is there support?
Support, Alguer.
Been moved, it's been supported. Is there any discussion? Seeing none, all those in favor signify by saying aye.
Aye.
Opposed? Motion carries. Next item we have is item C5, legal report, Van Overbeck, Michaud, Timoney, and Judd. Frank, it's up to you.
All right, thank you. I don't have anything formal for the legal report today, so I will just say hello to everyone and thank you, and that's it.
Well, thank you. Good seeing you again. Moving on to item D, informational items, list of 2021 VEBA board members. You've got a list there for your convenience. Does anybody have any questions, any discussion for this board? Seeing none, we'll go ahead and adjourn this meeting at 3:47. Thank you.